welcome back to my YouTube channel, Study with Clef. My name still remains Caleb, and if you are new here, please like, share, and subscribe. This is a page mostly important for accounting students or those preparing for professional examination like ICAN, and ACCA, and the rest of them. So welcome on board, and please share to as many as possible. Thank you. So today we'll be talking about an important standard, which is IFRS 13, fair value measurement. So if you're actually preparing for professional exam like ICAN, skills level or professional level, you would know that this particular standard is a very important standard as it relates to so many non-current assets and so many terms in the financial statement. So today we'll be talking about fair value measurement, which is IFRS 13, definition, the measurements, the evaluation techniques, and the disclosure requirements. Then after this, we'll take significant question to illustrate all of this. So thank you. So starting from the definition, IFRS 13 governs the accounting treatment for fair value. So just like we've been talking since, we did IAS 16, we've talked about IAS 40, IAS 38, that's PPE, investment properties, intangible assets, which we mentioned IFRS 13 in each of them. So what we mean by the fair value itself now in all of those measurements of non-current assets is what we'll be talking about. So according to IFRS 13, fair value, so starting with the definition now, definition. So according to IFRS 13, fair value is defined as the amount that will be received to sell an asset or the amount that will be paid to transfer a liability among market participants in an orderly transaction at a measurement date. So according to IFRS 13, once again, fair value is defined as the amount received or price that will be received to sell an asset or the amount that will be paid to transfer a liability between market participants in an orderly transaction then at a measurement date. That's fair value according to IFRS 13. So following this, said fair value is the amount that will be received to sell an asset or the amount paid to transfer a liability in an orderly transaction between market participants at a measurement date, that's at a particular date. So fair value itself, this is fair value. So we'll also define some terms in relation to this. We've talked about assets and we've also talked about liability in the first class where we talked about the elements of financial statement. So in case you missed that, you can go back there so that you can understand the terms of assets and liability. So we've defined assets and liabilities. So in an orderly transaction is the same thing as arm's length transaction. So in a normal market transaction, that's orderly transaction. So between market participants now, these are buyers and sellers in an active market. So those are market participants. Then at a measurement date, just like I've said, it's at a particular date. So here we now need to note that fair value is on exit price. Exit price. So fair value itself, what I mean by exit price is like the amount that you will be receiving to sell an asset and the amount that you will pay to transfer a liability in an orderly transaction between market participants at a measurement date. So that amount, this amount is an exit price. This amount also is an exit price. Do you understand? So now for us to have exit price, it means we must have entry price. So we also have entry price. So entry price is the initial amount which you have paid to buy this asset. For example, if you are saying you are selling an asset at a particular date. We must have purchased this asset initially before we sell, or we must have built it ourselves. We must have constructed it in place of construction, because asset is not just only things that you can actually build assets yourself. So it's either we've constructed this ourselves or we actually purchased it. So the amount spent at the initial stage of this asset is called entry price. So entry price is the amount that will be paid to purchase an asset, and also the amount that will be received to incur a liability. So entry price is the opposite of this. So entry price is the amount that will be paid to purchase an asset, and also the amount that will be received to incur a liability. But we now say that IFRS 13 relates to exit price, which is this. So exit price is the amount that will be received to sell an asset, or the amount that will be paid to transfer a liability between market participants in an orderly transaction at a measurement date, according to IFRS 13. So these are some of the terms. Then another one we have, so active market is a market where transactions take place. That's active market. An active market is a market where transaction takes place. So active market is divided into two types of markets now. So the first of it is the principal market, and secondly is the most advantageous market. So active market is grouped into two types. The first of them is the principal market, and secondly we have the most advantageous market. So the principal market is the market with the highest volume of transaction. Again, I say that the principal market now is the market with the highest volume of transaction. That is, market where transactions takes place the most. So, for example, we have market A and market B. Market A sells 10,000 per month, while 10,000 units of the product, while market B sells, let's say, 7,000. So, market A becomes the principal market in this case. So principal market is the market with the highest volume of transaction, while most advantageous market, on the other hand, is the market which maximizes the net amount that will be received, or the amount paid, or minimizes the amount that will be paid to transfer a liability. So most advantageous market is the market that will maximize the amount that will be received to sell an asset, and also minimize the amount that will be paid to transfer a liability. So we said market participants are buyers and sellers in a particular market, which is an active market. So active market brings us into principal market and most advantageous market. So principal market again is the market with the highest volume of transaction. So it's a market where the highest volume of transaction takes place. While the most advantageous market is the market which maximizes the net amount that will be received to sell an asset, or minimize the amount that will be paid to transfer a liability. So that's what it entails. The principal market is the market with the highest level of transaction, while the most advantageous market is the market that maximizes the net amount that will be received to sell an asset, or the market that minimizes the net amount that will be paid to transfer a liability. So that's for the two types of market. So the most advantageous market is expressed as this. So most advantageous market so it is given as the selling price minus transaction cost, then minus transport cost. So to get the most advantageous market, we'll have the selling price minus transaction cost minus transport cost. That's for the most advantageous market. Then fair value itself relates to several types of assets, which we've talked about. So fair value relates to IAS 16, IAS 40, IAS 38, IAS 36, and many other ones. Like we've talked about IAS 16, which is property, plant, and equipment. We've also done justice to IAS 40, investment properties. We've also done IAS 38, intangible assets. We are yet to treat IAS 36, which will subsequently do. So please, in case you miss any of the classes for these three assets, please just go back to previous videos so that you can have a knowledge of them or understand them better. And I will see how fair value relates to each of them when we are talking about their subsequent recognition or their subsequent measurement in each of these three. So I believe we know that already. So IFRS 13 relates to these assets. So this is PPE, investment property, intangible assets, and impairment of assets. We are yet to do impairment of assets anyways, but we're coming to it. So it is not limited to this. There are still many more that are related to IFRS 13. So I can just bring this out from many. And then the measurements. So fair value is measured using the active market, which is it is measured from the principal market or the most advantageous market. So in IFRS 13, which is fair value, the most important thing to take note of is that fair value is done using the principal market or the most advantageous market. So it means that you have to consider the principal market first and most advantageous market. Most advantageous market. So we've defined these two already, which are already on top. So the measurement of IFRS 13, which is fair value, is based on these two. So meaning that we have to consider the principal market first. So if we don't have the principal market, then we can use the most advantageous market for our fair value measurement. Do you understand? So the principal market means that if you have the market which has the highest level of transaction, you consider that as your active market. Like we said, that market participants are buyers and sellers in an active market. So an active market is what is divided into these two. So you should use your principal market as the active market if you have the principal market. But in the absence of a principal market, then you should consider the most advantageous market. So that's that. So using the principal market, you just get your fair value using the highest level of transaction in each of this market. So the asset which has the highest level of transaction. For example, for the principal market, so we have market A. Market A sells 50,000 goods in a month, while market B sells 80,000 goods in the same month. So both of them, they sell in the same month, but market A has 50,000 goods, while market B has 80,000 goods. So using the principal market, market B is the principal market, which serves as the active market. So we'll base our fair value using market B. Do you understand? That's one part. That is not the fair value, but that's how we actually determine which of this market is the principal market. So in the absence of this kind of information, especially in questions, which we'll see one of them. So in absence of this, we'll use the most advantageous market. So how do we determine the most advantageous market? We've talked about it. The most advantageous market is selling price less your transaction cost, then less your transport cost. So we have most advantageous market is selling price less your transaction cost, and you also less your transport cost. So this gives you the net amount that will be received. So if you compare between two different markets using the most advantageous market, so you did this for market A, you also do this same thing for market B. Whichever one gives the highest net amount becomes our active market, which our fair value will be based on. So fair value itself is not this, but we need an active market to be able to carry out our fair value measurement. So using principal market, you will be given several transactions. So the market with the highest transaction becomes the active market using the principal market. While if this is not given, you are to consider the most advantageous market. So most advantageous market is what brings about this. So you do the selling price of each of these markets, in each of these markets, less the transaction cost, then less the transport cost, which will give us the net amount that will be received to sell an asset. So the one that gives the highest net amount to be received to sell an asset becomes our active market under the most advantageous market. So in this case, transaction cost is the cost incurred to sell an asset or transfer a liability. So just like the name, transaction cost. This is using the principal market and also the most advantageous market. So if we don't have this, that is when we consider most advantageous market. Don't forget, if we don't have this information, which is the principal market, that is when we consider the most advantageous market. So valuation techniques now. So valuation techniques are just techniques of evaluating or measuring fair value. So how we determine fair value is the valuation technique. So we have three methods of valuing an asset: the market approach, the cost approach, then the income approach. So the market approach uses similar products or similar assets in the market to value our assets. So for example, if I want to sell this phone and then I want to know how much I can actually receive, just like we define fair value as the amount that will be received to sell an asset or pay to transfer a liability. So, and I want to determine how much I can actually sell this asset. So to determine the fair value of this phone now, I will check other similar assets that have also been sold. So I will compare them as long as they are similar. So I'll compare it and use the similar asset to judge my asset, which will be the fair value of my asset. So for the cost approach, that will be the replacement cost. Now I want to determine the fair value of my asset using replacement cost, meaning that if I'm going to replace this asset, how much will I spend? So the amount which I will spend to replace the asset becomes the fair value of the asset. under the cost approach. Then the income approach is the net amount that can be generated from the continual use of this asset, which is the present value of future cash flows from this asset. So this deals with discounting future cash flows. So here, so we said it is the present value of future cash flow. The cost approach deals with the replacement cost, while the market approach deals with other similar assets to judge our assets. So the price of other similar assets becomes the fair value of our assets. So under the income approach now, we said we use the present value of future cash flows that can be generated from the use of this asset. So the present value of it, and you know how we do present value. Present value means you are discounting future cash flows to reflect what it is now. So if, for example, I'll be receiving 30,000 next year, 30,000 in the following year, and 30,000 in the subsequent ones. So it doesn't mean that presently that 30,000 is still the same value as at now. So it would have reduced. It may not be up to 30,000 as at now due to inflation and like so. We discount future cash flows, bringing it back to the present state or the present value. So that's for income approach. So determination of fair value itself now. We determine fair value using the selling price less the transport cost. So this becomes the fair value. So when we are doing the most advantageous market, we consider both the transaction cost and the transport cost. But now, determining fair value itself, like I have said, it is not the same as most advantageous market. We only consider the transport cost as the relevant cost in relation to the asset. So we don't consider all the cost, which is the transaction cost and the transport cost. For fair value, we only consider the transport cost of this asset as the relevant cost in relation to the asset. So this is how to determine a fair value. That's that. Then for the disclosure requirements, so an entity must disclose. We said disclosure requirements are those things that you need or those things that must be disclosed for users of financial statement. So an entity must disclose its valuation techniques. So under fair value, it is mandatory that you disclose your valuation technique as an entity. Then also, you must disclose the impact of the fair value in the financial statement. Financial statement. So the company must disclose evaluation techniques for determining their fair value, and they must also disclose the impact of this fair value in their financial statement. So we've talked about the definition, and we also talked about some terms. We also talked about the measurement and the evaluation techniques down to the disclosure requirement. The fair value of a non-financial asset. Non-financial assets. So non-financial assets are assets with no specific claims or future physical resources or claims. So example of them, meaning that they are not generating any other cash flow apart from the use of these assets. Example of non-financial assets are PPE items. So example are PPE, which is like land, building, etc. So these are examples of non-financial assets. They are assets with no claims of financial resources apart from the use of these assets. That's for that. So how do we value a non-financial asset? So the fair value of a non-financial asset is done using the highest and best use approach. So we get the fair value of an asset, of a non-financial asset, using the highest and the best use approach. So the highest and the best use approach means that we check the fair value of an asset that gives us the highest amount to be received. For example, if it is the disposal of an asset, then we check the highest amount that can be received from this asset. So, and we also consider the use of this asset. For example, a land may be used for several things, may be used for production, may be used for sale. So, checking all of those use and comparing the highest amount is what the highest and best use approach is all about. Meaning that we are comparing what we can actually use this asset for, several things we can use them for, against the amount we can receive from each of these use of the asset. So the highest and best use approach is used to determine the fair value of a non-financial asset. So there's an example which will actually show on that before we actually end the class. So the highest and best use approach includes that it must be physically possible that we can use this asset. Then it must be legally permissible. Then it must be financially feasible. So before you can consider an asset based on its use, it must uh, meet these three conditions. It means that before we can say that this asset can be used for this, then that asset must be physically possible. It must be physically possible that we can use the asset for a particular thing. Then it must also be legally permissible. The law must permit that use of the asset before we can use that asset or consider fair value. Then thirdly, it must be financially feasible before we can consider it as using the highest and best use approach. So that's for that. So we'll take an example. So this is an extract from the professional level corporate reporting, November 2016, question 4, related to fair value measurement. So prior to the advent of IFRS 13, many standards such as IAS 16, IAS 38, IAS 40, and IAS 39, among others, require the use of fair value. These various requirements have been harmonized with introduction of IFRS 13, which is fair value measurement. Now require define fair value in accordance with IFRS 13. Now B, one of the companies formerly operating in Nigeria. So the A part, define the fair value in accordance with IFRS 13, which we've done as the amount that will be received to sell an asset or the amount that will be paid to transfer a liability in an orderly transaction among market participants at a measurement date. That's fair value, just like we've defined. Then the second part, which is the B part, says that one of the components formerly operating in Nigeria that had been recently relocated its operation to Ghana, as a result of the challenging business environment in Nigeria, has access to both Lagos and Accra market for its products. The product sells at slightly different prices in Naira in the two active markets. An entity enters into transactions in both markets and can access the price in those markets for the product at the measurement date as follows. So we have Lagos market and Accra market. We have sales price, transaction cost, transport cost, and net price received. Required. Briefly explain the principal market of an asset in accordance with IFRS 13 and determine what fair value would be used to measure the sale of the product if the Lagos market were the principal market. So they said if Lagos market were the principal market. The second one is how is fair value determined in the absence of the principal market and what fair value will be used to measure the sale of the above products if no principal market could be identified. So the B part, we've talked about the A part already, which is Lagos market. This is determination of fair value. So we have Lagos market, then we have the Accra market. So they gave us the sales price. We have transport costs or transaction costs. We have the transport cost and the net price received. So sales price of this is in thousand. Sales price of this is 260. Transaction cost is 30. The transport cost is 20. And this gives us a net amount of 210. Then for this, we have 250. We have 10 as the transaction cost in Accra market. Then we also have 20 as the transport cost in Accra market. Then we have 220. So the question says that we should briefly explain the principal market of an asset. So the principal market, just like we said, is the market with the highest level of transaction, highest amount of transaction. So in this question, there's no principal market based on this question because we're not given the level of transaction of each of these markets. So there is no principal market. But the question states that what will be the fair value if we assume, based on assumption, if we assume that Lagos market is the principal market, meaning that we are assuming that Lagos market sells more than Accra market. That's the meaning. So if we are assuming that Lagos market is the principal market, then what will be the fair value using Lagos market? So fair value. So if Lagos market is the principal market, fair value. Remember that we said fair value is calculated using the principal market. But in the absence of the principal market, we can now use the most advantageous market. In this question, there's no principal market. But they said we should assume that Lagos market is the principal market. That is why we're drawing this. So the fair value using Lagos will be the selling price, like we have said, selling price less transport cost alone. So the selling price is 260. then the transport cost is 20. So in this case, our fair value is 240. So we will not include transaction cost. Remember that we said it that transaction cost is not included when calculating fair value. We only consider the transport cost. So that's that. This is a professional question. It is CR November 2016 question 4. So sales price less the transport cost alone gives us the fair value. So in this case, this is the fair value. 240,000 is the fair value. So that's that. So that's the first requirement. The second one says, how is the fair value determined in the absence of a principal market? And what fair value would be used to measure the sale of the above products if no principal market could be identified? If there's no principal market, then the most advantageous market will be used. So the most advantageous market. So if the principal market of for a transaction is not given, then we use the most advantageous market to determine the fair value of that asset. So using the most advantageous market, we said most advantageous market is done using selling price, less transaction cost, and less transport cost. So the one that gives the highest net uh, amount becomes our active market, which is the most advantageous market. So in this case, this is Lagos. The net price received, they have already done the calculation for us, which is 260 minus 30 minus 20 gives us 210. Then for Accra market, we have 250, which is the selling price, minus transaction cost of 10,000, minus transport cost of 20,000, gives 220,000. When you are calculating most advantageous market, you consider both the transport cost and the transaction cost. But when you are calculating fair value, you do not consider the transaction cost. Take note of that. So we have determined that Accra market becomes our most advantageous market, of which we will calculate fair value on. So we will calculate fair value based on the most advantageous market. So Accra market. So using Accra market, fair value now. So fair value. It says fair value is selling price less transport cost. So our selling price in this question is, so we're using Accra market now because it gives the highest net amount that will be received. So 220 is higher than 210. So this becomes the highest, and so Accra market becomes the most advantageous market, which will be used to calculate the fair value. So the selling price is 250, while the transport cost is 20. Remember that we don't consider transaction costs in fair value. So this gives us 230. So using the Accra market, which is the most advantageous market, our fair value is 230. So this is basically illustrating what we have already talked about. So we'll also take another question to show the highest and best use approach, which is the fair value, the determination of fair value of a non-financial asset. X Limited acquired a plot of land developed for industrial use as a factory. A factory with similar facility and access has recently been sold for 50 million. Similar sites nearby have recently been developed for residential use as sites for high-rise apartment buildings. X Limited determines that the land could be developed as a site for residential use at a cost of 10 million to cover demolition of the factory and legal costs associated with the charges of use. The plot of land will then be worth 62 million. So calculating the fair value now. So this is an example. fair value of a non-financial asset. So that's for that. So they said X Limited acquired a plot of land which is developed for industrial use. So X Limited. Since we do not actually, we want to get the plot of land or the fair value of X Limited's plot of land, but we don't actually know. So we said using, remember the valuation techniques, where we said we can use the market approach, we can use the cost approach, and the income approach. So they mentioned here that a factory with similar facilities and access has recently been sold for 50 million. So if we already have similar facility, we can conclude that the fair value of this asset, if used for industrial use, remember that we said fair value of a non-financial asset is based on the highest and the best use approach, which will include the consideration of physically possible, then it must be legally permissible, then it must be financially feasible before you can consider it as an appropriate use for the asset. So here, if the land we have for development or for industrial use, if it is used for industrial purpose, it is used for industrial purpose, then we can say that the fair value is 50 million. So 50 million. If used for industrial purpose, to be 50 million. That's one. They said another site, which is similar site nearby, have recently been developed for residential use as sites for high-rise apartments. Said X Limited determines that the land could be developed as a site for residential use. So we have another purpose, so residential use. Remember that since no other obstacle or limitation have been set against this, that the industrial use will not be possible, then we will not be able to classify 50 million as part of the fair value of the land. But since no other information has been stated about it, we consider it to be legally possible, physically feasible, and financially permissible. So residential use, if used for residential purpose, said we would develop this land using 10 million. So 10 million will be used to develop the land. So development. So they said we'll use 10 million to develop the land. So after the development, the plot of land would then be worth 62 million. So the plot of land will now be worth 62 million, meaning that the selling price of the land becomes 62 million. So this becomes the relevant cost attributable to the sale of this asset. So this is the same as cost to sell. When we get to impairments, we also mention things like that. So here we have a total of 52. So for financial, non-financial assets, we said we base a fair value of an asset using its highest and best use. Since this land can be used for both industrial purpose and residential use, then we will consider both industrial purpose. It will give us 50 million. If the land is used for residential purpose, it will give us 52 million. Then the highest of the two is 52 million. Therefore, the fair value of the land is 52 million. So if, for example, they mention that uh, X Limited does not have the permit to use this land for residential purpose, then we will not consider any of these at all. So, or if they said it does not have the capacity to do any of these purposes, then we will not consider them at all. So it is assumed that since no negative information has been given related to it, then we will consider them to meet those three criteria. So that's in relation to IFRS 13 fair value measurement. So we've talked about the definition, the measurement, the evaluation techniques, and disclosure requirement. So I hope you understand how IFRS 13 fair value measurement is now calculated. So in case you have any question related to the question we solved or anything that is not clear, please use the comment section below. Thank you very much. Once again, this is Study with Clef, and my name still remains Caleb. Please like, share, and subscribe. Share to as many as possible people. Thank you very much. We'll see you in the next video. Thank you.